Hello and welcome to the MoneyMagpie Invest podcast. I'm Jasmine Birtles, founder of MoneyMagpie.com. And before we go any further, I have to say we've got to like, share, tell everybody about the Money Magpie Invest podcast. Oh, and comment as well, because we are genuinely really interested in what you have to say and we always reply. So do comment and share and all of that. So having got that out of the way, let's introduce my actual guest, who is Vicky Pryce, the economist and former government advisor. Vicky, thank you so much for coming on the podcast.
Oh, hi. Delighted to be on it.
Well, Vicky, I asked you to come on because after the spending review that Rachel Reeves gave, I have a number of questions about, well,
Mm.
particularly what you think that the review generally, if you've taken all of a piece, how that is going to affect the economy, because it seemed to me to be a spending review. And frankly, it worries me about, where we're going to find the money and how much borrowing it's going to increase on an already overburdened, over borrowed country.
Well, it's a very good question. And of course, we do know that we spend a huge amount on just servicing the debt that we already have, over 100 billion a year, which is a real worry. It might, of course, get more, unless something is done in terms of how much we borrow. And a lot depends on how markets react to various statements by the government. Because obviously, if the interest rates that we have to pay stay high, as they seem to be for the moment, if you look at the bond markets, then that cost is quite significant. So that's one of the issues, and this is why we need to be looking at that quite carefully. And I agree with you entirely. But the interesting thing about the spending review is that apart from the capital spending side, if you like, the investment, we'll get to that in a minute. If you look at the rest in terms of departmental budgets, the envelope for those budgets had already been set. So we were going to get just from here on, from next year actually, 1.2% per annum for 3 years in real terms. And the question was how they were going to be allocating that money. And the way that they have had to do it is, tinkering around a little bit, probably, compared to what they intended to do, because of course there have been extra pressures now, particularly on defense. And that's one of the pledges that they have made to increase the share of spending on defense of GDP to 2.6% by 2027. And if that is to happen, then you need to find some extra money. So there was a little bit of reallocation that took place. And if you then also look at what's happened to extra spending that is absolutely needed, as far as they're concerned, for the NHS to meet some of their pledges, it hasn't left an awful lot for loads of other government departments. And that's really where the worry is, except maybe for energy and climate change. And even there, it's mostly capital spending rather than day-to-day spending. And the pledge, as I'm sure everyone remembers, is that on day-to-day spending, there is to be no borrowing. If you finance it at all, you finance it through taxation. And that's what is worrying people right now. But where the real extra spending is happening is on capital, where again, there had been an envelope, but that envelope seems to be a little bit more fungible, if you like. And the reason for that is that there's been a recalculation of how you look at that type of investment in terms of how it affects your fiscal rules. And that recalculation is that there is an asset, you spend the money and then you get some returns. And if you calculate over a period of time the net present value of that spending, then you could argue that actually you're bringing something positive into the economy to offset some of the spending, which means that your debt to GDP ratio figure becomes a little bit better in the longer term, and you can meet that rule as well. So that's where I think the question marks will be, and that is why we're going to be looking very, very carefully at what the Office of Budget Responsibility says in terms of its longer term forecast by the time we get to the budget, the proper budget in the autumn.
So there are a few things I'd like to pick up on there that you've said. Firstly, if we go back to the beginning of what you were saying, the bond yields, as you say, they are high. They are higher than when we had the Liz Truss budget. I was actually speaking to a bond trader last night, and I was saying, "Aren't you worried? Aren't you worried that it's 5.5% now? It was 4.5% at the height of the Liz Truss budget." And she said, "No, no, it's a question. It's sort of been a gradual thing, so that hasn't been a problem." Do you think it's a problem, or do you agree that it's really just a question of volatility more than the actual figures?
If I remember correctly, when I looked at it last, I mean, we were around 4.5%, but some rates have been coming down a little bit and up at various days. But yes, we are roughly where we were at the time of, that's for the 10-year yields. Of course, huge differences, and you're probably right if you're looking at different maturities. But the rates are more or less there. And we had all said at the time that we were at the brink of some, financial collapse. And the truth is that there were parts of the financial sector that were threatened by this at the time. The government has changed things a bit. The Bank of England intervened, provided a lot more liquidity. So we're better prepared, if you like, for the types of rates we've got now. But yes, what it does indicate to the markets is that there is, or rather, what the markets are indicating to the government is that they are still concerned about the overall level of spending. And it is absolutely true that in order to do the spending the government wants to do, they have had to go out and borrow more. So if you compare where we were at the last budget of the Conservative government, which was back in March 2024, it does feel like a long time ago. What they did at the time is put themselves a projection of what type of spending there would be, because obviously, and borrowing, because obviously the OBR was involved in authenticating these figures, if you like, the Office of Budget Responsibility. What the new government has done with their first budget is, in fact, spend at the time, that was how the envelope came that I mentioned before, over the period of Parliament, 70 billion more a year than what the Conservatives had in their own budget of March 24. And that extra 70 billion would be financed, as we've already seen, of course, happening with the increase in taxation, with 40 billion extra taxes a year. That's on average, okay? And 30 billion of extra borrowing a year. So this was massive. This is really how all these figures of how much borrowing there will be through the whole Parliament now look really quite large, because that is precisely what the government intended to do. But of course, a lot of that borrowing, as I said earlier, is for capital investment. So that should bring some growth. And since you started by asking what it all means, that growth takes time to have an impact, or rather that spending takes time to have an impact on growth and therefore on our day-to-day living standards. And that, could be something which is quite elusive. It may happen early, may happen later. So look, for example, at the intention or the announcement by Ed Miliband, who is the Energy and Net Zero Secretary of State, who announced this extra 14 billion for spending on Sizewell C, which is new nuclear plant. This is public sector spending. That, of course, requires for it to become at all effective and to make any sense and to be spent. This requires a lot of private sector investment to come in as well. So a lot of what we've been hearing about public sector investment also needs the private sector to come and do it, even on housing, affordable housing. We'll be spending that on affordable housing, which is a huge amount of money, which is, if I remember correctly, something like 30 billion pounds extra, which we didn't expect to see. Well, over 10 years. Actually, it was 39 over 10 years. So it depends on housing associations and the private sector to come in and do it. And they will, of course, need a number of incentives. Already, some incentives were given on the housing associations front in terms of affordable housing, by at least having some agreement about what rent increases there might need to be to make it at all viable for anyone to go in and provide that housing. But a lot will depend on whether, small house builders will be incentivized to do so, whether the planning regulations move fast. So loads of question marks. So thinking again about the market, yes, of course, the figures look large, but they may in fact not need to borrow that amount of money if the rest doesn't happen. Or they may need to borrow more if they have to put more because the private sector doesn't quite respond. So huge uncertainty, therefore. in those figures. And it is entirely understandable that the markets reacted by just not doing anything very much, just waiting and seeing, and maybe we'll get a little bit more clarity at the time of the budget. So I think for the moment they're treading water.
And yes, as you say, more clarity with the budget. And what Mel Stride said in response to the spending review is that we've got a cruel summer of wondering where the hammer's going to blow, where it's going to fall, because it's got to be paid. It's not just, as you say, it's not just going to be borrowing, it's going to be taxation or again. And we already feel like we're overtaxed. What do you think is going to happen in the budget? What kind of taxes do you think are going to come up?
Well, that's the $1 million or £1 million question, of course. It is interesting when you listen to what some of the cabinet ministers have been saying, and Ed Miliband was one. When he did an interview for the BBC a few days ago, he was arguing that even the reversal or the U-turn on winter fuel allowance, and also the possibility, although he didn't quite talk in detail about that, the possibility of some welfare changes such as a removal or an easing of the two child benefit cap that exists at present, weren't sort of big issues and would be accommodated within, the government budget. His assumption, one guesses, was that we would get growth in the economy, and therefore you get more revenues, and therefore it's easily manageable. Which is interesting. Then you wonder, why did they do it in the first instance if it's so manageable now? But it remains to be seen what happens by the time of the budget. And of course, we've had some rather bad data on the economy just recently, which showed a drop in GDP in April. Who knows what will happen the rest of the quarter? So you may not get quite the growth that perhaps Rachel Reeves hopes for, but what will be crucial to answer your question of where some of those tax increases, if they need to be, fall, will be what the OBR does in terms of recalculating their forecasts for the economy over the next few years, and therefore what it means for the fiscal rules and the envelope that Rachel Reeves may have and the headroom that she may have under those rules.
I mean, as you say, they're hoping for growth, but it seems to me that if you're going to tax and tax and tax and still be looking to give out benefits, etc., something's got to give. It's like trying to run with manacles on your feet, it seems to me. I'm hearing quite a few people saying, well, I'm going to give up work, I'm going to take early retirement, I'm going to leave the country. These are just people I've been speaking to here and there, and some of our readers saying, I'm just not going to bother. Do you think we're going to get this growth? Because it doesn't look like it at this moment.
Well, right now, of course, we have some extra geopolitical pressures. We have the trade concerns with tariffs from President Trump. We're negotiating something in the UK, which perhaps will limit some of the cost to us, but it's still going to be costly. So, and it's quite likely that the basic 10% that all firms have to live with, if you like, when the extra tariffs which will be imposed of what they sell in the US of 10% may still remain for all areas of the economy. There may be, of course, as we've been discussing with the US, some exemptions for steel and aluminium, and who knows what the agreement may be on cars, but there are still going to be extra costs in exporting to the US. We're trying to do more trade deals, and we've seen some that we have signed with India, although it's limited. We're trying to reset with the EU, and that would be good news if it works a little bit more. So there are attempts to do that, but overall, the positive ones that we're signing are only going to add a little bit to GDP, and it would take quite some time for that to happen. And right now, of course, we're also seeing oil prices rising because of the tensions in the Middle East, which have escalated. And that, if it becomes permanent, obviously is going to also affect people's real living standards. So that's going to be a bit of a problem. We've seen firms already react negatively to the increase in the national insurance contributions. rate and the easing of the lowering of the threshold from where it starts. And we've seen that reflected in hiring intentions. The unemployment rate has gone up a little bit. I mean, yes, you're right that there is also an activity rate, which is still very high. People are giving up, perhaps. And yet, if you look from a demographic perspective, we absolutely want all the workers to carry on working for as long as possible because we absolutely, well, we worry about the dependency ratio. So there is all that there. And so there are serious concerns about what type of growth and how fast they would be. What options are there to raise taxes? The easiest one is, of course, to do something on income tax or national insurance contributions or VAT. It's unlikely they're going to do anything of that sort. So what they might do is they might just look at the threshold for starting to pay income tax. That threshold is supposed to no longer be frozen from a couple of years' time onwards, where they might extend to the end of the parliament. And if that is the case, then they will be collecting quite a lot more for the last 2 years. And really, it's crucial for them because the last 2 years is when you're expecting them to see whether you're meeting your fiscal rules before the next election. You can actually say, yes, yes, we've done it. So I would suspect that that would be, if they need the money, that would be the easiest thing for them to do.
And you've mentioned the dependency ratio, and this is something that I'm seeing mentioned a little bit more now. The fact that 52% of the population is essentially taking more than it's giving into the system. So it's only 48% that are contributing more than they take out. And this to me seems unsustainable. And I mean, I'm thinking, about a business, for example. If you think of the UK as a business, surely we need to make lots of cuts before we can really properly grow. And yet, of course, nobody wants those. They certainly don't want the cuts that really probably we should be making. Is there any way around this? Is there anything the government can do, or even if it doesn't really have the will to cut?
Well, as we've seen, they're trying to reform the welfare packages that exist for people. And of course, they're particularly worried about the disability payments that are being made, and they're trying to restrict those. And as we've seen, they've had huge amount of pushback, if you like, from backbenchers and others. And of course, concerned that, Labour Party should not be penalising those with difficulties. But of course, we've seen this big increase, and there is no doubt if you look at any predictions of the welfare spending that will need to be done if we carry on as we are, it sort of takes over. And of course, if you look at welfare spending already, it is the biggest part of what we spend because, of course, it includes pensions. And yes, the dependency ratio is such that, if you increase pension age so that people work for longer, then obviously it improves a little bit because, if people are not producing enough offspring, what you end up with is fewer people supporting those who don't work. But of course, the interesting thing is that at the same time, and I'm sure any survey you've seen will have said the same, that older people find it difficult to get jobs because there is discrimination against them as well. So you might end up simply with older, non-pensionable people yet out of work and in poverty, and then you have to increase other types of benefits for them. So it's not really in itself a solution, but we could see what happens in other countries. So interestingly enough, among the G7, the country which has the largest percentage of the population of working age, if you want to call it that, who is still employed and doing things over 65, is Japan, which of course has seen a remarkable drop in its fertility rate itself, and a drop in its population. In fact, if we carry on like this, already demonstrated. So you could do various things, and but it's not really the solution. And all those who are saying let's just have more children, it takes a long time for that to have an impact. And also, while they are children, they're dependent on you, so you actually have to support them.
Very good point. Yes, different types of dependency. So finally, Vicky, as we talk about investing, should investors be still considering the UK as a good place to put their money? I keep hearing that it's cheap. I mean, we're seeing a lot of M&A activity, lots of foreign companies coming in and buying UK companies at bargain basement prices, it seems. So do you think that investors should be looking at the UK as part of their portfolio, or is it still a little bit rocky, would you say?
Well, much will depend on what happens to growth, whether the investment environment is one that says, well, yes, there are going to be returns there for the future, and we do know that there are indeed some bargains, and people are willing to come and take the risk, if you like. But you're right. I think assets in the UK remain quite cheap. And there are possibilities, and we're seeing precisely that taking place right now. And of course, US firms possibly also being more interested in doing things here, particularly if there is a special agreement on the trade front with the US. I think that would be an advantage. But also the way in which the UK is now moving closer to Europe. It was always a gateway to Europe. That, of course, suffered a little bit with Brexit, and it is still suffering. But if we are able to reverse some of that and we see a greater integration again, then I think that would be quite a positive part of what may be a more attractive scenario for the UK in the future.
So you do feel that having closer ties with Europe is actually useful, even though Europe seems to be having astounding economic problems itself.
Of course, but look at one area where there is going to be an awful lot more spending, such as defence. We're very much likely to be part of this big fund, the 150 billion fund, which has been set up in order to finance the expansion in terms of spending on defence across Europe. The UK, if it participates in it and also gets involved in the whole procurement process as well, we'll see some of the companies in the sector do really rather well. And we do have quite a strength in that area. And I think the Europeans probably look at that and believe that that should be an integral part of how Europe moves forward on the defence side itself. So yes, and there would be also lots of opportunities on the technical front, because the interesting thing about defence is that there are trickle-down impacts for the rest of the economy. A lot of investment is going to be needed on R&D and technology, and lots of indirect jobs can be created, indirect firms that can supply the defence industry can also develop in the UK, and there are particular parts of the UK which provide that type of advantage with a lot of skilled labour in it as well. So yes, I think there are prospects for attracting more investment, and the government is realised that, and they have a special office now to get more investment in through that. I remember there used to be something called the Invest in Britain Bureau, which was abolished, decades ago. But it actually worked rather well at the time. So they're trying to recreate something like that. And I think that's important. But it needs to be emphasized a bit more strongly across the world that this is how we're moving. And there are also attempts to deregulate various areas. And that we have to watch a little bit, particularly in the financial sector. But overall, I think a positive trend, if it can be demonstrated that you also limit the risks that way as well.
Very good point. I agree. We should bring back the Invest in Britain Bureau. I don't even remember
Mm.
that. So I think, I remember Buy Britain or Backing Britain. I can't remember, but there's something, it's not a bad idea for us to be a bit rah, rah, rah about our country and invest in Britain, build Britain up, rather than pulling it down, which is what a lot of us have been doing recently.
Just to say they are moving in that direction. I think I saw an announcement that they are recreating something like that, and they're encouraging lots of firms to be involved in it.
Good, good. Well, Vicky, thank you so much for talking to me. Vicky Pryce, economist and former advisor to the UK government. Thank you very much for that. And just to remind you, nothing that's been said in this podcast should be taken as financial advice. It's financial information. That's all. Do speak to a financial advisor if you're wanting to get some actual advice. And as I said at the beginning, don't forget to share us, like, and comment. We always read your comments and we do reply. We're very interested. This has been the Money Magpie Invest podcast. I'm Jasmine Birtles, and I'll see you next week.